Hey everyone, welcome back to another Meet Kevin report. If you could give me a thumbs up that you can hear me and everything's working okay, I'd appreciate it. Welcome back to Meet Kevin report number 61. It is a little bit challenging to travel and set this up, but I have figured it out. Anyway, super excited to be here. We have a ton of stuff to cover today. We're probably going to be starting with the banking crisis evolving since now we have a little revisit to talk about of the banking crisis. We'll be talking about Deutsche Bank and we'll be talking about crypto later, along with the commercial real estate sector and all the other madness that's going on in the world today. It's kind of wild. These times are pretty uncertain. There's a lot of nervousness out there, and I have to say, if anybody's in really between the ages of 20 and probably 50, not knocking on the door of retirement age, this is probably going to be looked back upon as one of those times of the best times to potentially get great opportunities of buying into depressed assets. That's my belief. A lot of people think, no, wait, it's all going to get worse. Everybody always says that, but I have this long-term thesis that look, if you can buy the bottom half, it's better than buying the top half. So keep it simple, stupid is what I always like to say. So anyway, hopefully this works out and y'all can hear this a-okay, and then we'll go ahead and continue on. So it looks good. All right, fantastic. So here we go. Let's go get started with Deutsche Bank because that's going to be the big topic today, and then we'll get into some of the crypto and commercial real estate stuff, as well as some of the shenanigans that are going on with Silicon Valley Bank. That's kind of a wild to think that we have shenanigans going on, but then again, that's exactly what you do get. Yeah, we're gonna get 2008 all over again. Well, I hope not. Anyway, okay, let's get started. So, well, folks, just as we thought the banking crisis might be over, the banking crisis is continuing to evolve. Take a look at this screenshot of the pricing of credit default swaps for Deutsche Bank. On the right side, you could see the skyrocketing of credit default swaps. Now, we have been at this level before in September and October, but why are we potentially revisiting those levels again? Well, it's potentially because the banking crisis is actually just getting started. Is it possible that Silvergate and Silicon Valley Bank, as well as Signature, and those bank failures could all just be the tip of the iceberg? And the answer to that is absolutely and unfortunately yes. Now, don't worry, says Jerome Powell. Jerome Powell tells us our banking system is sound and we have nothing to worry about. And Janet Yellen says mostly the same, although stopping short of suggesting that we'll fully guarantee deposits. In fact, Janet Yellen flip-flopped on Wednesday. On Wednesday, Jerome Powell suggested, don't worry, all deposits in the banking system are safe. And when he was challenged on that, suggesting, hey, wait a minute, are you now saying that FDIC insurance is extended past 250K? Because that'd be good. That'd be a way for you to prevent the banking crisis and the banking runs from continuing, right? He said, don't worry, deposit outflows have stabilized and we have our tools, but that's all we're willing to say. That same day, Janet Yellen said this here. Oh, that's inconvenient. There we go. Unfortunately, I want to show you this photo, but my iPad does not want to cooperate. Anyway, in worst case, I'll read it out here. Oh, here we go. Solving that. Janet Yellen said the following on the left. She said, as I said last week, okay, come on, there we go. As I said last week, the U.S. banking system is sound. Federal government's recent actions have demonstrated our resolute commitment to take the necessary steps to ensure that depositors' savings remain safe. That was different from what Jerome Powell said. That led to a lot of nervousness. Like, hey, wait a minute. Jerome Powell just said everyone's safe. You're saying you're taking steps to make sure everyone is safe. That led to nervousness. So the very next day, when she then testified before the other chamber of Congress, she revised what she said. She said the following. As I've said, we have used important tools to act quickly to prevent contagion, and they are tools we could use again. The strong actions we have taken to ensure Americans' deposits are safe. Certainly, we would be prepared to take such actions again if warranted. In other words, hey, we just want to align with what Jerome Powell said. Yes, we still have tools on the tool belt to protect the banking system. Don't worry. No, we're not guaranteeing everything, but trust us. Everything is fine. Well, why then are banks like JP Morgan down 10% in just the last 2 weeks? Why then are credit default swaps, which are like an insurance premium to protect an investor against loss at a bank, skyrocketing. And why all of a sudden are we seeing this fear arising even amongst companies like UBS again that, we might actually have more pain coming than we expect? Well, it's probably because of the A1T wipeout over at Credit Suisse. That A1T wipeout was actually a really big deal, and it started to lead to margin calls around the world and a lot of panic that, wait a minute, nobody really knows the scope of what's going on. And that is creating nervousness. Take a look at this article here. Here's an article from the Financial Times talking about how the A1T bonds were wiped out. Now, what's really important to know before you go into this is that bonds and somebody who holds a bond is really just somebody who holds an IOU, right? If you lent me $1,000 and I gave you a piece of paper back that said I owe you $1,000 back, it's just like you're holding a bond. Now, let's assume you're holding that bond and you're like, okay, well, if Kevin defaults, I get access to all his stock holdings first. And that's generally what a bond is known as. But now you have Swiss regulators who came in and said, you know what? We want somebody to buy this bank and we want somebody to get those assets that Kevin has, maybe for pennies on the dollar, but we want somebody to buy those assets. Let's just screw the bondholders holding that note and wipe them out before we wipe out the shareholders. Now that is really weird because yes, those bondholders can get wiped out with A1Ts, but not usually before the equity holders. But that was the most convenient way to facilitate a deal at Swiss banks. And so that's exactly what happened. The A1T bondholders got completely wiped out, written down to zero, while shareholders received $3.25 billion. So in other words, $17 billion of bonds were wiped out, while shareholders actually received $3.25 billion, which is at least something on the value of the company. Now, that has led to this fear of others starting to sell these bonds. Look at this. Selling pressures amongst A1T clients, especially wealthy clients, are starting to receive margin calls. Why would they receive margin calls? Because these were deemed to be super safe and they had almost a 10% coupon. Think about this. A 10% coupon is like saying, hey, I lent you $1,000. Will you pay me nearly 10% interest? Sure. And don't worry, you're safe before the shareholders. And then what happens? You get rug pulled. You get wiped out before the shareholders get wiped out. But you were expecting to get 10% interest. And what's happening now? You're getting absolutely nothing. And so these wealthy family offices throughout the world, whether they're in China, in different parts of Asia, or in Europe, who invested in these A1T bonds thinking they were safe, are actually getting wiped out. And now they're getting margin called. And now they're panicking, thinking, oh my God, well, if this could happen at Credit Suisse, then maybe this could happen in other banks as well. And maybe we should sell out of this. And this is much riskier debt than we thought. In fact, the Financial Times is quoting people saying the following: we haven't slept since Sunday, said one Singapore-based private banker. People are completely gobsmacked. Now, what is a private banker? Well, a private banker is a banker that helps work with people who have generally more wealth than normal people who bank at the bank. And you usually have three levels. You have, for example, if you go to Chase, you have anybody who walks into Chase who can open a bank account. Then you have the private bank, which is usually where you have more than $250,000 in assets. Or you have the JP Morgan Wealth Bank, which is when you have more than $10 million in assets. These private bankers are the people usually representing people with a lot of wealth, and they are seeing their clients freaking out over these bonds getting wiped out. And it's leading to fears that the same kind of stress could happen at other banks. And that is why we are now seeing credit default swaps at Deutsche Bank skyrocket. And what is that leading to? It's leading to their stocks plummeting. In fact, in pre-market trading, Deutsche Bank stock is down as much as 13%. And you're starting to see the same kind of pain in American markets, down 13%. European markets. Right now on the Nasdaq, or sorry, the New York Stock Exchange, we're down 9.53% on Deutsche Bank in pre-market. You've got a more limited response to U.S. banks, but they're down. J.P. Morgan, for example, is down 2.24%. So you're starting to see fear that Janet Yellen and Federal Reserve Chairperson Jerome Powell might not be capable of handling this contagion, because all of a sudden, if Deutsche Bank starts having problems, you're going to have a whole lot more problems. Why? Well, because Deutsche Bank employs 82,500 people across the world. On top of that, it has $1.5 trillion in assets. Think about that for a moment. Silicon Valley Bank had $211 billion in assets. 1.5 trillion is a multiple of 7. That is, you are now starting to see stress at a bank that is 7 times the size of Silicon Valley Bank. It is 3 times the size of Credit Suisse, and banks across the world are now suffering. France's Société Générale is down 7% this morning. Deutsche Bank is obviously a German bank, in case that wasn't clear. UBS is also down, as the Justice Department is now probing UBS. Silicon Valley Bank is supposed to be sold this weekend, with bids due tonight. Yes, bids are due tonight for Silicon Valley Bank. Gosh, bids being due tonight kind of remind me of something. So yesterday, as a tangent here, this amazing person who works for me, Justin, just sent me a message that we have now introduced. Take a look at this. A new feature for the courses on building your wealth that let you now buy now, pay later with either Affirm or Klarna or any of the other buy now, pay later services. Kind of cool. I didn't know we could integrate that. We now have that. A lot of people have been requesting a buy now, pay later option. And while I'm not the biggest fan of buy now, pay later, we now have that as an option for the courses on building your wealth, link down below. So in honor of that, we have extended the coupon code just today, so that way you could use that coupon that was supposed to expire Wednesday, along with buy now, pay later. So congratulations if you're interested in using that. But anyway, going back to Silicon Valley Bank bids are due tonight. Bids will be open until this evening, and the bank is expected to be sold over the weekend. Now, what's fascinating about that is they want this bank to be sold before the market opens on Monday to prevent panic of a disorderly sale. Keep in mind, the kind of recession that we could be walking into could be a balance sheet recession, which is exactly what you're seeing happening at these banks. These banks are seeing their balance sheets deteriorate at the same time as bank runs and fears are being caused at specific banks, leading to a consolidation of assets at larger banks. But not just at banks, people are also fleeing banks. And the reason people are fleeing banks is because you can essentially get a yield at non-banks and money market funds. Why bother getting a yield at bank if you can get yield at money market funds? Look at this, folks. Brett Whitten, fantastic guy, brilliant mind over at ARK Invest. I'll tell you, Kathy would, like her or not, she employs some fantastic researchers. Look at this chart right here. Money market funds seeing a skyrocketing Google search result, sort of an explosion of Google search results over here. Why are you seeing this explosion of Google search results? Well, you're seeing it because people are looking for a safer place to put their money. And why are people doing that? Well, because why put your money in the banks if you could just put your money in treasuries or money market funds and basically get a yield that you couldn't otherwise be getting? It's fantastic. So searches are skyrocketing. What is that doing? It's leading to more of a run on the banks. That's incredible, but it's also not good for the banks. So what's next? Well, Silicon Valley Bank is expected to be sold this weekend. Listen to what happened at Silicon Valley Bank, and it shows you, dare I say, the near corruption that happens at these banks. You know how Joe Biden came out and said, hey, don't worry, even though we bailed out depositors, we punished the executives because they got fired. Really? The executives got punished? Well, guess what Silicon Valley Bank just told us about executives getting punished? Do you want to hear it? Here it is. Executive pay at Silicon Valley Bank soared after the bank embarked on a strategy to boost profitability by buying riskier assets exposed to rising interest rates, according to the Financial Times analysis of security filings and people familiar with the matter. The jump in pay for CEO Greg Becker and CFO Daniel Beck was the result of large multi-year bonus awards pegged to the bank's return on equity, a measure of profitability that rose sharply between the risky lending period of 2017 and 2021, filing show. Well, isn't that a little bit of a surprise? No, it's not a surprise at all. Why is it not a surprise at all? It's not a surprise at all because obviously when banks are encouraged to be riskier, what happens? They make more profit in the short term. So the executives get paid more money. That is not good because it encourages more risky debt. That is not fantastic. So what do you have? Well, you have Joe Biden telling you, don't worry, everything's fine. The banks are going to be safe because they're going to have good risk mitigation because otherwise they'll get fired. Really? The CFO was also the guy who worked at Lehman Brothers in 2008 and then moved on to earn a $1.4 million bonus in 2021 alone, making $3.8 million a year at Silicon Valley Bank. Becker, the CEO, made $10 million in 2021. Oops. It's ridiculous. We are also seeing bids for credit or Silicon Valley Bank from companies like the Bank of London. That is not to be confused with the Bank of England, which is the central bank. It is to be considered the Bank of London, which is a bank that's only existed for 2 to 3 years. Like, who wants these toxic assets? Nobody. In the meantime, we're seeing margin calls in the A1Ts market. We're seeing bonuses getting frozen by the Swiss government. We're seeing Janet Yellen and Jerome Powell freaking out, and they can't even align with their own discussions and the way they're trying to assure American depositors. And at the same time that's happening, what's lining up? The next bank failure. Yes, before I read you this one, you're going to want to get yourself life insurance because, well, yes, I have a partnership and a sponsorship with life insurance. Had it for a very long time, and it is fantastic. You can get life insurance in as little as 5 minutes by going to McKevin.com/life. You get Apple Pay or Android Pay for it in as little as 5 minutes. You can get screened everything right through the app. It took me 5 minutes. It took Lauren, who's got asthma, like 7 minutes. It was great. Take a look by going to McKevin.com/life. The next bank failure is coming. PacWest Bancorp is apparently now moving to shore itself up after customers pulled 20% of their deposits since the start of the year. $1.4 billion of financing has been established from partners. They have abandoned a capital raise thanks to a surge in customer withdrawals. PacWest has now borrowed $3.7 billion from the Federal Home Loans Bank, and they've borrowed $10.5 billion from the discount window, and they borrowed $2.1 billion from the BTFP, the Bank Term Funding Program from the Federal Reserve, their emergency facility. And folks, they have seen an outflow of $4.9 billion just from venture capitalists. That is out of the total of $6.8 billion that have flown out of PacWest Bancorp in just the last couple of weeks here. Now, this comes at the same time as First Republic received a $30 billion infusion from 11 strong banks, with JP Morgan leading the effort. But guess what? It has not really helped quell the pain at all. In fact, if you look at First Republic Bank stock, it is down 6% yesterday, 4% in the last, or pre-market here, in the last 5 days. It's down 50.8%. In the last month, it's down 89%. In the last 6 months, it's down 90%. It is near record lows in pre-market today. It might break record lows today. It's pretty remarkable. This is not good. Not only is it not good, but the US government, as much as they're telling us they're willing to swoop in to guarantee deposits, because after all, quote, their intervention was necessary to protect the broader US banking system. We cannot have a guarantee that if you have deposits in excess of FDIC insurance, that you will actually be protected. So what should you do as somebody who's just trying to get through this crisis? Well, in my opinion, the best thing that you should do is make sure that if you have money in excess of $250K, you have it spread out over different banks. Use the FDIC insurance calculator to make sure you're spread out appropriately, especially if you operate a business. Use multiple different banks, multiple different bank accounts. Now, even if you do not have money in excess of $250,000, I think it is worth having money at maybe 2 to 3 different banks. Have your money separated. So that way, if for some reason your assets were temporarily caught up in a banking shutdown or freeze for a few days even, you'd still have access to capital for a few days. It's not a bad idea to have multiple different bank accounts. So I'm a big fan of that, and I think you should consider it as well. So consider that these small and medium bank contagion fears are real. Remember this. Now, it's also worth noting that there's a lot of resistance to creating any kind of universal guarantee on deposits. I think this is why Jerome Powell and Janet Yellen have this inconsistent messaging. They don't want to send this message that there is a universal guarantee because, as the House Freedom Caucus says, quote, any universal guarantee on bank deposits, whether implicit or explicit, enshrines a dangerous precedent that simply encourages future irresponsible behavior to be paid for by those not involved who followed the rules. This is true. Remember, folks, people like to tell you that no, the bailout of Silicon Valley Bank was by no means taxpayer funded. Well, that's only a half truth. While it is true in spirit, taxpayers are backstopping that bailout. If there's any loss of money from that Silicon Valley Bank fund, you're either going to pay for it through the Treasury's appropriated fund, with the Treasury backstop fund that actually backstops the BTFP from the Fed. That is, the Treasury backstops it. And who's funding that program? You, the taxpayer. But not only that, you might also see it in higher fees at the other banks that you bank at as the FDIC tries to recoup some of their damage. Peter Schiff tweeted on Monday, the U.S. banking system is currently insolvent thanks to the Fed and the FDIC. Banks were much sounder under the gold standard and prior to the FDIC. Today, we have 18 trillion in deposits, quote unquote, insured by 100 billion in treasuries. The value of all bank deposits will soon be destroyed by inflation, says Peter Schiff. And he's not terribly wrong about a lack of actual insurance. It's worth noting that the FDIC only has enough money to insure dollar for dollar about 1.95% of all deposit reserves. Oopsie doopsies. That's not great. Here we all are all wondering about how stable coins are backed 1-to-1, yet the FDIC is backed just 1.95 cents to every dollar you have deposited. Now, we do happen to have the Fed with the money printer, which is nice and somewhat useful, but it's also slightly concerning. So, worth keeping an eye on what's going on in the banking system because, well, ultimately it affects all of us. But not only does it affect us in terms of our banking, it also affects the market. There's a reason the market is red today on these renewed fears of Deutsche Bank sparking concerns of potentially global contagion. At the time of this recording, most indices are down 0.5 to 1%. We're also seeing actually a flight to safety of bonds. That is, the 10-year Treasury yield is down 9 basis points to 3.31%. Now, part of you might be thinking, well, this is fantastic. That means mortgage rates are going to come down, right? Not so fast. Mortgage spreads have widened so much that even though the 10-year Treasury has fallen about 80 basis points, mortgage rates are still close to 7%. They're not actually coming down because risk premia measured via spreads are actually rising. Oopsie doopsies. Now all of a sudden, you're not seeing mortgage rates come down while people are fleeing to the safety of bonds and bond yields are coming down. That's a bummer for real estate, but it's actually a good thing for banks. See, as treasury yields come down, what happens? The value of bank bond portfolios actually goes up. That is actually a good thing because it could potentially mitigate how much of these toxic assets banks have on their balance sheets. Remember, these banking crises started just a few weeks ago when the 10-year Treasury yield ran up to an almost all-time high during this cycle, the last few years cycle here, to about 4.1%. We've dropped about 80 basis points, 0.8%, in just the last week and a half here. That is actually a fantastic way of propping up the valuation of the maturity or the held to maturity bonds and the available for sale securities that banks have on their balance sheets. In English, the more treasury yields fall, the more stable the banking system ironically becomes. However, it's coming at the same time as now we're worried that Deutsche Bank could collapse, a bank that's 7 times the size of Silicon Valley Bank and 3 times the size of Credit Suisse. However, the more pain we see at Deutsche Bank, ironically, the less pain the rest of the banking system faces. But is it likely that we're going to continue to see more bank failures in the near term? Absolutely. And that's why I think it's incumbent upon every individual to check out the programs on Building Your Wealth link down below to get that amazing perspective that I share with you, not only daily here on YouTube, but in an organized manner on the programs on Building Your Wealth, either Zero to Millionaire Real Estate Investing, one of our most popular courses, the Stocks and Psychology of Money group, also one of our most popular courses, get fundamental analysis nearly every single day when the market is open. Join the Elite Hustlers to learn how you can make more income, increase your income, whether you're W-2, negotiate those pay raises, whether you're an entrepreneur looking to learn about liability and LLCs and insurances, tax strategies. And remember, none of these are designed to give you personalized advice. They're designed to give you a head start, broad way that you really just don't get on YouTube. So fantastic. And guess what? Now we have a buy now, pay later option available for all those of you who have been asking for it. For the programs on Building Your Wealth, link down below. So check those out. We've briefly done a one-day extension of that coupon code, so that way those of you who are interested in using Buy Now Pay Later can do so. All right, there you have an update on the Deutsche Bank crisis. That was a lot. It's unfortunate that now we are dealing with a continuation of this banking crisis. It's also unfortunate battery levels on my iPad are going down. Hold on one second. I have a solution for that. They have ways of making you charge. Yes, stand by. Plug that in. Haha, success. All right, fantastic. So, next up, there's so much to cover today. Thank you so much. Kevin's always on the go, and we'll do the show wherever. I see you on Twitch. I see you people watching, you Twitch folks. Yes, it's very inconvenient to not be in the studio, but I do my best anyway. You know, we're on day 61 of doing this in a row, of basically waking up at 3 a.m. and trying to bring as much value as possible to y'all. I actually really enjoy it. All right. We've now got to talk about a quick little political note. So let's go ahead and pull this up from Political, and then we'll jump back into some market talk. All right. Let's see what we got here. Oh, and we can also listen to CNBC for a second while I get this up. Let's listen into CNBC. Let's see what happens. Let me know if you can hear this. Should be able to when I do. Do I do a screen present? Oh my goodness! Here we go. I can't. Oh, here we go.
A horrible decision. All of a sudden, investors around the planet focus on that. And then on top of that, the ECB raises rates and celebrates that raising of rates. And then the cost of capital for banks in Europe, the ECB doesn't understand. When they're raising rates this high after the AT1 scandal, banks can't fund themselves. You know what I mean? These banks need lower cost of funding.
Yeah, and the those were providing some of that, and they're not going to be able to go to that well anymore. Yep.
Aren't the other AT1s bonds different in other places? I mean, I subjugated below equities. I thought the other ones, that wasn't the case. Am I wrong with that, Larry?
No, that's right. But what happens is there's such a shock, and you're absolutely right about that, because we run a conversation with institutional investors, and there was like a day period where people were mixing the two. But it's just like people, after they watch, preferreds get eviscerated below equities very fast, everybody just like kind of goes, okay, I don't trust this. And then all of a sudden bank funding across the entire AT1 ecosystem, which is essentially like a junior subordinated preferred stock, all of a sudden that funding kind of evaporates, and then the cost of capital for banks to fund themselves changes dramatically and alters, and then all the eyeballs come on. Okay, who's the next victim? Who's the next lien that has to bear? And the serpent in the market, that beast in the market wants to find that next victim.
So what you're saying sort of is, all right, so Silicon Valley Bank brought the attentions back to banks in the financial sector. So all of a sudden we're going to look under the hood at all these different banks. But the problems under the hood were already there. It's not Silicon Valley Bank's problem. So we knew this renewed interest in what's going on at Credit Suisse or Deutsche Bank So is that going to spread across the continent? There's going to be.
Good
How
question.
does this end, Larry? Is it going to be stemmed in some way? What would you do if you were regulators over in Europe at this point?
Well, remember the regulators. I wrote the colossal failure common sense about Lehman Brothers. The two regulators had an office, including the New York Fed, inside of Lehman, and the regulators had an office inside of Credit Suisse. So unfortunately, regulation is difficult when you have people that make $10-20 million a year at a bank and a regulator making a couple $100,000. It just doesn't work. It never works, right?
Larry, what could regulators and authorities do this weekend to stem some of this crisis of confidence?
Well, they're going to have to open the door to a softer path. So the ECB, what they did, I mean, Trichet, remember, in 2011 celebrated that rate hike, and a month later Europe was in flames, right? And so Trichet was the ECB president, and the same thing just happened. The ECB did 50 bips. They're trying to put out the inflation fight. God bless them, right? They had horrible inflation in Europe. I really sympathize with their position, but you're hiking rates to put out an inflation fire, and you're increasing the cost of capital, making banks function in a very poor way. So they're going to have to just at least acknowledge the fact that the hiking cycle's over and that rate cuts are around the corner, and that'll put up the fire for now.
All right. Thanks, Larry. Thanks for the quick being available so quickly for us. The news, that's what's called news, keeps happening. We'll see you later. Thanks.
Unfortunately.
Yeah.
Okay.
The bank's borrowing from the Fed is near the levels of the financial crisis, according to the Fed's latest balance sheet release. For more on the Fed, the banks, and everything else, we want to bring in Sarah Bloom Raskin, who served as a Fed governor and deputy Treasury secretary during the Obama administration. She's now a law professor at Duke University and a CNBC contributor.
All right, let's pull off of CNBC for a moment. So we've got to do a quick update here on a Trump piece, and then I want to talk crypto. So, and then we'll go back into some other finance. So stand by one sec. Congress, what do we got here? All right. Let's see here. Okay, perfect. Well, folks, Congress has been denied access to information regarding the investigation into Donald Trump, and that's pissing off a lot of Republicans. Apparently, Congress has been rejected demands from 3 specific GOP House chairs seeking potentially sensitive information on Trump. The general counsel for the investigative attorney, Mr. Bragg in New York, responded suggesting that Congress is pulling a, quote, unprecedented inquiry into a pending local prosecution. Now, we can look at their letter here to respond, or their response to Congress, but here's basically what's happening. Congress is investigating or trying to get some insight into why potentially the district attorney of New York is investigating Donald Trump going into the 2024 election. This is leading a lot of folks to think that this is politically motivated. Of course, the New York attorney generals respond and say, look, we're investigating $130,000 of hush money from 2016, which is way beyond the statute of limitations, although there's some extensions if you commingle in campaign finance potential violations, or potentially the New York, the city of New York and the state of New York's extension of certain statutory limitations. You have arguments that there were potentially falsified business records, other campaign finance violations. You've got the mishandling potentially of official documents and or racketeering charges, all these various charges that are potentially being laid against Donald Trump. And the New York Attorney General is essentially investigating Donald Trump. And the New York Attorney General is arguing that we never said Trump was going to get arrested. Trump is alleging this. Now, that's actually very interesting, because if we just put aside, for example, what the potential crimes are, what's very interesting is the fact that by Donald Trump suggesting, hey, I might get arrested, what he's actually doing is rallying Republicans around him, specifically those who are supportive of Donald Trump or are seeking votes or affirmation from potentially the Trump base, which could be potentially as much as 30 to 50% of Republicans. Around 30 to 50% of Republicans identify as essentially MAGA Republicans. There's nothing wrong with that. But the point is, there are a lot of people who see, wait a minute, we have to make sure that if you're considered a Republican, you have to at least be somewhat sympathetic to Trump. And so as a result of that, what do you have? Trump comes out and suggests, I might get arrested. There's a witch hunt going on. And so what do Republicans have to do? Well, first of all, they all get asked at every single press conference, what are you doing about this political witch hunt? So what do? They send letters to the New York Attorney General and suggest, why are you investigating Donald Trump? That way at press conferences, they can say, well, I don't know what's happening, but I've sent a letter demanding information, right? That this is all a game. It's all a political game. It's so that individual Republicans in Congress can say, I am going to get to the bottom of this, and they can wag the finger at the New York Attorney General, right? That's the idea here. And so the New York Attorney General, well, before we get to what their response is, it's worth sort of thinking this through for a moment. If Trump thinks there's a risk he's going to get indicted, even if he doesn't get arrested, or there was never an intention to arrest him, it suggests that he may. That creates the political spectacle. That leads to more Republican support. Then all of a sudden it turns into, wait a minute, the Attorney General is a Democrat. I get it. This is Republicans versus Democrats. What an outrage. The office of the Attorney General is being weaponized to punish political candidates they don't like. And all of a sudden now, scrutiny on that New York Attorney General amplifies substantially. You got people protesting outside of that office, the New York Attorney General's office. And so what ends up happening? Well, potentially charges never come. Maybe this just all blows over and nothing ends up happening. It's the perfect move of 4D chess by Trump. Not only has he gotten himself back in front of mainstream media attention, because everybody's talking about this. The people on the right who are Trump voters anyway are like, this is an outrage, right? Outraged voters, what do you think they do? They vote. People who are uninspired or unoutraged don't vote. So, for example, a lot of people say, look, DeSantis might be okay for Republicans, but if he doesn't inspire people to get out and vote, they won't vote, and then he won't win. Whereas if Donald Trump can inspire outrage, then what might people do? They might vote. Donald Trump doesn't need Democrat votes because he ain't going to get Democrat votes. So what does he care if CNN talks about him all day long about how he deserves to be arrested and justice is finally happening? He doesn't. They would all say that anyway. But instead, he has motivated the Republican base through this, what some are saying is just a charade. Now take a look at the District Attorney of New York's response. Yeah, Steve here. Steve is Mr. Gold over here. Steve says, Trump, a genius. I am not, as I can't spell genius correctly. That's all right, Steve. We still love you. But anyway, take a look at this. Here is the letter from the District Attorney of New York. All right. This investigation is just one of thousands investigating potential violators to protect New Yorkers. And this congressional letter is an unprecedented inquiry into a pending local prosecution. The letter came only after Donald Trump created a false expectation that he would be arrested the next day, and his lawyers reportedly urged you to intervene. Neither fact is a legitimate basis for a congressional inquiry. In other words, the New York Attorney General is saying, this is ridiculous. Why is Congress intervening into a local prosecution? How could you do this? This is not fair. What we'll do is we will agree to meet and confer with you all to see if there is any non-sensitive information we can share with you. But quite frankly, the New York Attorney General is saying this is a waste of time. You all are saying we are weaponizing the political system. You all are weaponizing the political system. And it doesn't even matter whose side you are on in this. You know what this is? This is a play right out of Trump's book, The Art of the Deal, which he co-wrote. But anyway, it's brilliant. This is another way to put this in non-Trumpian terms, is what I actually call chaos theory. When you create chaos, guess who's in control? You are. Let me give you an analogy. Let's say you're getting sued and you are pissed that you're getting sued. What do? You create chaos for the other side. You pepper them with requests to the court in every single angle possible. You make their lives miserable with requests in email and text messages and voicemails, and you purposely make their heads spin because that means you're in the driver's seat and you're in control. And you could tell the judge, I left them a voicemail on this day and this day and this day, and I texted them and I emailed them, and they're not responding to all of my requests. They are dropping the ball. It's part of the game. It is part of the brilliance of what I call chaos theory. It is a brilliant move, like him or not. Remember, my goal here is to report to you. Look, I have two goals when I make YouTube videos, okay? Number one is to try to give you non-biased information as much as that is possible in our insane world. I know that means I'm going to piss off some people on the really far left. I'm going to piss off some people on the really far right. But my goal is really just to provide information for people in the middle, because that's the campaign that I ran for governor in California, is running as somebody in the middle. It's a hard campaign to run, but I think I did a very valiant effort. We almost got 1 million votes in California. That's actually pretty impressive, I think. So this is actually a brilliant strategy, because now you literally look at this, okay? The New York Attorney General had to put together a 5-page, pretty detailed report here on or response to Congress with citations, responding to case law, responding to allegations that this investigation is only being done, here's the quote, to, quote, punish those being investigated. In other words, that potentially the New York Attorney General is just doing this to punish Donald Trump because they don't want him to be elected. And as a result, they're being asked to disclose confidential information regarding a criminal investigation, and that this is now impeding with an impartial or independent inquiry into these potential crimes that Donald Trump allegedly has committed. And I mean, they go through citing case law like crazy. I kid you not. There's a lot of case law here. Look at this. They cite Eastman versus the U.S. They cite Barenblatt versus the U.S. They cite Kilburn versus Thompson. They cite Watkins. They cite multiple different cases: Bond versus the United States, Cameron versus Johnson, Prince versus the United States. The New York Attorney General is literally freaking out over what is now congressional inquiry into Donald Trump. And instead of actually being able to investigate, what have they now? Well, now they have to worry about the media spectacle outside their office. They can't even walk into the building without getting harassed. There are now police standing outside of the New York Attorney General's office because there are so many threats to it. There was a suggestion that Donald Trump was going to be indicted by the New York Criminal Court on Tuesday, which didn't end up happening. But what happened on Tuesday? The same day that indictment was supposed to come, guess what? A bomb threat gets called in, which ended up getting cleared as a hoax, but a bomb threat gets called in to that New York court. In other words, New York is like dealing with this insane fallout because Donald Trump says, I'm going to get arrested. Well, the reality is that may not have ever happened. But by suggesting that, Donald Trump has A, taken control of the narrative, B, summoned every Republican to his defense, and 3, completely distracted the New York Attorney General, and 4, has every armchair attorney in America going through every possible allegation against Trump and evaluating how sticky the allegations actually could be. It's crazy. It's actually it could actually play in such an insanely good way for Donald Trump. But take a look at this. They do suggest that charges could still happen, so it's worth addressing that. If a grand jury brings a case against Donald Trump, the DA's office will have an obligation, as in every case, to provide a significant amount of discovery from its files to the defendant so that he may prepare a defense. And then that way, Donald Trump can basically provide the information, right? The letter's allegation that the DA's office is pursuing a prosecution for political purposes is unfounded, and regardless, the proper forum for such a challenge is the Court of New York, which are equipped to consider and review such objections. In addition, review by the U.S. Supreme Court would be available to the extent any criminal case results out of this. In other words, they're saying, look, give us a chance. Like, literally, the New York Attorney General is begging, please just give us a chance to finish our investigation. It'll all come up in court. And when it all comes up in court, you'll have plenty of time to analyze all of the potential claims at that time. But let us at least get to that point. But that is the point. This is why Donald Trump is able to control the narrative, because he's now distracting them with all of this and potentially delaying the fact of them ever being able to bring these charges up in the first place. And they have to deal with all of the armchair defenses that are coming up in the meantime. It's a very interesting case of really, dare I say, weaponizing your base to respond to potential political weaponization of the justice system. It's kind of a 4D chess move. You got to give him credit. Now, I know that pisses people off. I mean, sometimes then I get the commentary that Kevin's being a Trump apologist. I'm simply being an observer, and I'm saying, look, no Democrat is going to vote for him anyway. But what it's actually doing is it's actually making it more likely that you get a Donald Trump reelected. So you have to think about that. So if you're a Democrat, if you hate Donald Trump, you have to realize him getting arrested increases the chance of him actually getting elected. There's a reason that Elon Musk said on Twitter that if Trump is arrested, guess what? He'll win by a landslide victory. That is what not only Elon Musk said, but then guess what? Of course, Trump Jr. retweeted. Trump arrest will lead to a landslide victory for Trump, Elon Musk says. And then, of course, multiple news sources are covering that as well. That's the point. So now what? Think about the optics of this. If this is a politically motivated prosecution of Donald Trump, well, now all of a sudden they have to contend with the fact that Republicans are like, go ahead, arrest him. I dare you. Do it. So we win. That's the idea, right? Like, it's so brilliant. Now, not only have you distracted the DA, but you've basically said, go ahead, do it. It'll be great for our campaign. So if it's politically motivated, that basically just potentially got destroyed. But if it's not politically motivated, it basically just also got destroyed to some extent because the DA can't even get to the offices without getting harassed. They have to defend all these allegations from Congress and all these distractions. And they have to deal with all the armchair attorneys investigating all of this stuff. I have to say, it's brilliant. It is absolutely brilliant. And again, even if you hate Donald Trump, you have to look at this and go, wow, this does create an issue. Because look, there are people all over on the left. And I look, I follow both sides. Okay. I really try my best. There's this, although I think most people who comment on politics take stuff way out of context. Both sides. I hate it. Like Benny Johnson, almost always out of context. Although he does provide some good, sort of like updates. Always out of context though. But it's the same thing on the left. Like the politics girl or whatever. Oh my gosh, every video of her is so out of context. But it's designed to just get followers from the left. Just like some of the other stuff is only designed to get followers from the right. There's very little coverage in the actual middle. And so let me give us sort of a bottom line to Congress being denied access to the Trump investigation. What is the result of all of this? The result of all of this is very simple. Number one, Donald Trump just became the most popular Republican candidate with a more galvanized base. So now he's kicking potentially DeSantis or Abbott in the butt. We weren't even announced yet. We don't even know if Abbott will go. Pretty clear DeSantis will end up going to run. Nikki Haley, who's talking about her? Who's talking about the other guy, the ESG fund guy, the billionaire dude? Nobody. Nobody's talking about them. And how do you win elections? Everybody talking about you. Again, if you're a Republican, you don't need the Dems liking you, right? So the implication of all of this is Donald Trump has just galvanized the right vote through all of this. So if it's politically motivated, that just backfired. That is this prosecution. If you're a Democrat, you should actually be not cheering this, because the fact of the matter is, even if he's indicted and punished, do you really think he's going to end up getting sentenced to where it actually prevents him from becoming president? Probably not. And if you end up putting Biden against Trump, we saw what happened with Hillary versus Trump. Okay, I'm not saying what's going to happen, but I do think a galvanized Trump is the worst nightmare for Democrats. Just saying. Okay, my take. Hopefully that was insightful to you. That's just my take. I know people get mad at me when I talk about politics. It's because I try to be in the middle, but I really do try to do my best here. Now, the good news out of all of this is you can now use a buy now, pay later service to check out on the programs on Building Your Wealth link down below. We've activated not only Affirm, but Klarna and other options where you can now buy now, pay later to join the programs on Building Your Wealth, linked down below. As a result, we've extended that coupon code to tonight, so that way you can take advantage of that buy now, pay later if you so desire. All right, next step. What is next? The next step is very simple. All right. Okay. Let's see what's next. So that was that. Now we've got to talk about. Oh wow, yeah, the commercial real estate piece is fantastic. But we can also talk about what's going on with Binance, which is also pretty intense, as well as what's happening with Kwon. Why don't we do that? We could start with that, and then we'll jump around. So CNBC just did a fantastic piece. It shouldn't actually come as a terrible surprise, but the piece that came out. But we'll look at it here. All right. Alrighty then. Let's get started on that. Let me turn this up a little bit. Oh, that's too bright. No, actually, that's perfect. Look at that. See, we got an adjustable light over here. Isn't this great? All right, ready? Here we go. Well, folks, we just had another big crypto arrest. Kwon was arrested in Montenegro on his way to, you guessed it, Dubai. And CNBC just released a massive hit piece on Binance. Yikes. Let's talk about both of those. So, first of all, Kwon is the founder of Terra Luna, which is a complete disaster that many say started the crypto collapse that we are now, well, enjoying, dare I say. Some actually like that word enjoy because you see it as a buy the dip opportunity on Ethereum and BTC. But Terra Luna's collapse led to the collapse of Three Arrows Capital, which led to the collapse of Voyager Digital, which led to the collapse of Celsius, which led to the collapse of BlockFi, which led to the collapse of FTX. It's all a connected disaster. It was a dominoes disaster. Not the pizza disaster. Dominoes falling disaster. So Kwon has been fleeing from South Korean prosecutors who have basically been on a hunt for this guy, and they finally found him because for some reason he actually thought it would be a good idea to try to get on a plane. Somehow he made it all the way to Montenegro, which is in southeastern Europe. It's over there by like Croatia. But instead of staying by land, he decided to go into an airport. And then he tried to use fake Costa Rican travel documents. Now, there are allegations that he has siphoned billions of dollars from Terra Luna and should have plenty of money to actually get a high quality fake, but apparently couldn't get a good quality Costa Rican passport because he got caught. Immediately after he got caught, the U.S. Justice Department filed charges against him for fraud immediately. As soon as he was caught, more charges were filed against him. Now, he was on his way to Dubai. Why do people go to Dubai when it comes to crypto? It should be obvious. Dubai, in the United Arab Emirates, does not have an extradition treaty. People go to Dubai for two reasons. One, low to no taxes. Number two, no extradition treaties. So, if you're a wanted criminal in America because you made a lot of money via fraud or otherwise, where do you go? You go to Dubai. Where is our Cayman Island-based Binance located with CZ at the helm? Oh, that's right, Dubai. Yes. Also massive and many U.S. security charges against CZ of Binance. Now, every time I talk about CZ, people get very defensive of CZ. I have to give CZ credit. They survived so far. They had a massive run at the end of last year, and so far they have survived. We, just to catch you up to speed, have regularly found that CZ likely commingles the funding and backstopping for multiple coins on the Binance platform. That is, when they tell you, hey, all of our coins are backed one to one, what they're really saying is, hey, if we have a pot of $1 billion and then we have 3 different coins that all have $1 billion of assets underneath them, at any time, if you take a snapshot, they're backed one to one because the pot is backed one to one to this coin, and then one to one to this one, and then one to one to this one. But they're never all backed in their entirety at the same time. This is pretty obvious at this point. So if you hear from Binance that coins are backed one to one, probably not. In fact, probably the same assets that are sitting in, quote, Seifu, probably the same assets that are basically people's deposits that are backstopping multiple other coins. So if everything was facing some form of liquidation at the same time, probably be running into some issues. But I have to say, they were able to survive what happened in December, which is very, very impressive. Now, though, what is CNBC telling us? Well, CNBC has done a pretty interesting deep dive into Binance. And this deep dive was actually associated with the Binance Angels. Now, Binance Angels are apparently trained volunteers. They are potentially paid for by Binance, but indirectly, probably through blockchain-based wallets that make it very difficult to track how people are actually getting paid. But angels technically identify as Binance employees, but Binance calls them volunteers, sort of like the community moderators. And what these angels were caught doing by CNBC was basically in a Discord server of about 220,000 users. They were basically teaching people how to get around the know your customer rules in China. And after all, well, not just the know your customer rules, I should say, in America, but also the fact that, remember, crypto has been banned in China since 2017. The platforms have been banned since 2017. Pretty much everything's been banned since 2021 in China. And CNBC did an investigation looking into, wait a second here, what do we have here? We have Binance and these Binance angels teaching people how to circumvent the Chinese rules for actually accessing Binance. They go as far as suggesting that Binance created an app that makes it easy for you to circumvent the rules so you could sign up for Binance in China. Not only do they recommend using VPNs based in the United States, Singapore, Hong Kong, or even Taiwan to basically restrict or circumvent these Chinese bans, but they also encourage you to use overseas email addresses when you sign up, such as Outlook, Gmail, or Proton Mail. And if you end up choosing China as a place of residence, just choose Taiwan while you sign up, so you can sign up and then change it back to China afterwards, so you look like you're in compliance and you never lied, but you could sign up to get through the gate via these ways. Really, what CNBC is alleging is that basically Binance set up this system of purposefully leaving holes in their system so they could tell China, look, we ban people. See, you can't sign up if you click you're from China. But then leaving back doors open that they can then teach their Binance angels how to teach people about. And then after they teach their Binance angels about it, they can tell the world about it so people could actually sign up for Binance. Take a look at this. This was the CNBC piece. It was actually a phenomenal piece. they mention here in multiple different places. Well, they do multiple different interviews here with different people talking about it. Look, if I had an 8 out of 10 concern when it comes to Binance for a regulatory perspective, from a national security perspective, I have a 10 out of 10 concern. A lot of people just call this a FUD, right? Of course, but this is real. So what's happening? Binance employees are explicitly prohibited from supporting users and circumventing their local laws. But that's okay, because you call angels volunteers. They're not employees. They're just volunteers. So you have to kind of read through the read between the lines, so to speak, to see how they're talking basically out of both sides of their mouths. But anyway, Binance has stopped letting Chinese register with their mobile phone. So you can't use a Chinese mobile phone, and they're trying to ban people from being able to use VPNs. Yet at the same time, you have these angels in a Chinese Discord server saying basically use overseas emails, use VPNs, so that way you could sign up for Binance. Here in December 2022, a person with the handle Stella was identified as a Binance community manager, explained how people can use a specialized VPN-free domain name and download an app which appears to be specifically tailored for customers in mainland China to use Binance services. CNBC was provided a link to this app from an email address with a Binance.com domain. A reporter was able to download the app from a location within China without a VPN and register using a Chinese phone number. So even though Binance is telling you, oh, we don't take Chinese phone numbers, apparently you're able to sign up with a Chinese phone number. So apparently all the back doors are basically wide open. It's like doors closed in the front, wide open in the back. We'll show the Chinese government the front, we'll let you in the back. This is the kind of stuff that happens over at Binance. A reporter, let's see here. The app is hosted on Tencent, which offers a cloud computing software popular in China and offers the ability to purchase crypto using popular Chinese web apps like WeChat and Alipay. Now, Binance says we don't offer any kind of Chinese-specific app. There's only one official app. Sure, there is only maybe one official app, but you happen to offer another app that lets people backdoor the rules. And then, of course, the angels come to the defense as well, saying we don't speak on behalf of Binance. We're just volunteers. So they've really been trained, potentially in a process that takes as long as a year to train these angels. And there's even a hiring page, according to Binance. This page has since been deleted. CNBC actually talks about that in a moment. But apparently, these angels go through a separate training process that takes up to a year. And they're vetted, trained, and deployed across Binance's Telegram and Discord groups, operating under the supervision of Binance employees. And they basically teach people how to circumvent rules so you could sign up in China, saying things like, oh, don't worry, your proof of residence is not required. Or if you're going to submit Chinese identification documents, don't worry, just go ahead and claim to be from Taiwan, use your Chinese identification, and Binance basically just will turn a blind eye. We just won't look. So that way we can bypass all this stuff. Binance reiterated that angels are not employees. It's just an ambassador program. Don't worry. And angels are forbidden from sharing recommendations that are against our policies or law. Of course you're going to say that. Of course. Of course, CZ calls this very innovative. Yes, it's very innovative how to skirt the law. And basically, you have even been able in Europe to use a Visa debit card created by Binance to let people turn their crypto into fiat for use anywhere. Visa declined to comment on the story. Anyway, basically, the story goes on and on and on. CNBC asked Binance to share commentary on this, and as soon as CNBC asked Binance about this evidence CNBC had, guess what happened? Hours after Binance reported to CNBC, messages appeared on Twitter suggesting that some customers' Binance debit cards had been frozen. Why was my Binance card frozen? And multiple of the websites that showed the hiring pages and Discord servers were basically deleted. So in other words, CNBC just caught Binance red-handed, again, trying to skirt the law. Or dare I say, not trying to skirt the law, but actually skirting the law. It's not a surprise. That's what Binance does. That's what they've been doing. That's why their owner is in Dubai. So we can't be held subject to all of the drama of regulation. And in some sense, can you blame them? I mean, look at what Coinbase is going through. Coinbase is going through absolute freaking hell. Now, let me give you this, okay? I know some people are like, oh, Kevin, just crypto flooding or whatever. I actually think to some extent, CZ is doing this because they realize if you try to do it the right way, you're effed. It ain't going to happen anyway. Look at what Coinbase is going through. Coinbase is going through absolute hell and back to try to get just out of the SEC's crosshairs. They want a way to get registered with the SEC. They want a way to legitimately work with the SEC and register their offerings. But now the SEC sends a Wells notice to Coinbase, and Coinbase is like, what the hell? Now we have to go through even more lawsuits and more problems. Now, look, I'm not an apologist for Coinbase. Maybe they're doing stuff wrong. We don't know. We'll find out when the actual investigation comes out, right? And I'm also not a straight apologist for the SEC, although I do think that the SEC is, as we all know, the government is a bureaucratic organization. Their hands are probably tied by Congress, ultimately. And then it's a bureaucracy, not just within the SEC, but also amongst all the other agencies. Commodity Future Trading Association, they don't have a consistent message between them and the SEC. There's no coordination. Why? Well, probably it's because Congress hasn't passed any kind of authorization for them to do anything. Now, again, I'm not trying to apologize for the SEC. Just saying, like, Congress needs to do something. Because until then, Coinbase is going to keep complaining about stuff like this. Look at this. Coinbase has this massive blog post from their legal counsel about how they got this Wells notice and how they've been trying, that they're disappointed because the SEC has been working with them forever. And Coinbase has multiple times been and spending millions of dollars trying to provide proposals to the SEC about registration, all of which the SEC ultimately refused to respond to. Honestly, I don't think the SEC wants to refuse to respond. I think they look at all the proposals and they're like, probably not a bad idea, but guess what? We can't do anything anyway because we don't have the congressional authority to do it. So people at the SEC are probably pulling hair out of their heads going, crap, like we have to follow our government mandated mission, which is what Congress tells us to do and the Biden administration tell us to do, which is, protect the banking system and minimize fraud. And so what's everyone cracking down on? Well, crypto. Why? Because guess who was really exposed to crypto? Signature Bank in New York and Silvergate. And guess what started the freaking banking crisis? Silvergate Bank and Signature. So it's all correlated. When you have banks that fail because of crypto, and those bank failures lead to more bank failures like Silicon Valley Bank, and then Credit Suisse, and now potentially Deutsche Bank. Well, what do you have? You have the government and people like, Elizabeth Warren pounding their fists on the table going, we need to protect the banking system. Well, all you're doing is amplifying pressure on the SEC to put pressure on crypto. And the more pressure goes on crypto, the more the crypto companies in the SEC's crosshairs have to deal with this stuff. That's why, in my opinion, Coinbase has to deal with this because of the banking crisis. CZ is registered or has Binance registered in confusing entities in the Cayman Islands, and he lives in Dubai because it's quite frankly, now he doesn't have to deal with all the regulation. No, that doesn't mean he's not a fraud. He very well could be. I don't think all of his assets are backed one-to-one. I think their audits are bogus. I would not have a dime in Binance. Would I maybe use, I don't want to come across as endorsing. I'm certainly not endorsing. But if I was in a foreign country and I'm like, look, I'm just going to use Binance to buy coins and then take them off exchange rather, and put them on a cold storage wallet. Maybe that's my only choice to get involved in crypto, right? Especially if I'm in a country where my currency is being devalued. Like if I'm in Turkey, I'm like, dude, I'd rather get my paycheck and throw it all into crypto. I'll use Binance, throw all my money into crypto, and I'll be a lot safer from the 60% inflation we're experiencing in Turkey. So if you think about this, can you really blame people? Can you really blame people for putting their money in crypto with all the inflation that's happening in the world, especially in developing countries? Of course not. Can you really blame people for therefore using brokerages that enable them to do that? Of course not. Can you really blame the SEC when they're getting all this pressure from Congress because of the banking failure? Of course not. Who can you blame? Well, you blame the people who were actually the frauds and who had terrible risk management procedures who led to these collapses, like Three Arrows Capital and FTX. That's who you blame. But guess what? Everybody else now has to deal with the consequences. What you're basically doing is you're socializing the pain. That's what's happening in crypto. The pain is being socialized. So everybody who's left in crypto who wasn't a scumbag has to deal with the leftover pain. And the reality is that's probably Coinbase, because they're publicly registered with the SEC. Now, being publicly registered doesn't mean the SEC approves of everything they're doing. Now, they do say that in here that, hey, you let us list. Why did you let us list then? Well, that means nothing. That means nothing. Just because you sent your documents for review with the SEC and the SEC is allowed to add commentary so you add more disclosures doesn't mean they approve of crypto. Fortunately, that's also confusing, though, because like we said yesterday, it's like, how could you potentially punish us for something we don't even know is illegal or that you don't even know is illegal? It's a challenge. But it's all because of the banking crisis and this bureaucratic crisis that we're going through. I don't really think, with the exception of people like Sam Bankman-Fried and potentially CZ, I don't know. I can't say that for sure about CZ, but you can say that for sure about somebody like Sam Bankman-Fried. I don't know that individually, if you're involved in crypto or you have a crypto company or whatever, that anyone is necessarily a fraud. We can't say that, right? I think everybody's trying to do their best with the information they have available. And we're just in a very frustrating time for the crypto ecosystem. And the stuff like the CNBC investigation doesn't help. But then again, people in China obviously demand that. Just like there's a demand in a black market. There's a reason why. Well, because people are trying to potentially get their money out of China. And China doesn't want to flight of capital out of China because all the money's going over to like Hong Kong or Singapore because people are like, get me out of the CCP. I don't know. And again, I'm not trying to apologize for everybody here. I'm just trying to provide perspective from every point of view. The point of view of a citizen in China who's just trying to, have control of their own money, or the citizen of Turkey who's trying not to get inflated to death, or the bureaucrat working at the SEC who's legit trying to do their best, but they can't because of all the red tape, or the people in Congress who are like, we should pass crypto regulation. But dude, Congress ain't going to do jack shit over the next 2 years. They ain't going to do anything over the next 2 years. I was in an interview yesterday, news interview yesterday with a TV station. And they're asking me, what do you think is going to come out of this TikTok banning thing? I'm like, nothing. Congress is not going to do anything over the next 2 years. There's too many politics involved. Now, would I invest in Coinbase right now? Hell no. And that's not, I went through their financials yesterday. Their financials are terrible. Their financials are absolutely horrible. But beyond that, the regulatory disaster that you would be walking into investing in Coinbase right now, it doesn't make sense. It's not for me. And look, yes, I am a licensed financial advisor. I run an actively managed ETF. I have courses on building your wealth. You can learn about all of those. You can even click to what my ETF is by going to meetkevin.com. All of these things, just go to meetkevin.com. You can see it. It's not a secret. It's all there. But this information is not personalized financial advice to you. Let me just put it this way, though. When I look at the Coinbase fundamentals, like we did yesterday, I get a little nervous. Why do I get a little nervous? Well, because their revenues collapsed. Their revenues nearly halved last year, and their operating expenses nearly doubled last year. Why would I invest into that? It's very, very risky, especially in this sort of regulatory regime. Now, is that necessarily fair that Coinbase has to deal with sort of my criticism because of regulation? Yes. Yes, it is. It's absolutely fair because the reality is you as an investor have to be aware of the headaches that they have to go through. Now, look, I'll give them a positive note, okay? Yes, they have about $4 billion at least of free cash. That's fantastic. Then they are losing money, right? And their free cash flow is not that great. And insiders are selling Coinbase. But beyond that, you have to look at the actual fundamental business model. They're just not that good. These people have about a 2-year runway rate at about that $1.58 billion in negative free cash flow they have. But beyond that, if you look over here, you can see it. Their revenues went down $4.2 billion while their expenses went up $1.7 billion. And you've got the regulatory risk. I can't touch them. Can't touch them with a 10-foot pole right now. So that's just my take. Now, another take that I have, which I think is really awesome, is this take that now you can, if you want to, take advantage of, check this out, buy now, pay later on the programs on building your wealth. Link down below. You can now sign up for the programs on building your wealth using Affirm, Klarna, or some of the other services. So check those out. We extended the coupon code to end today instead, so that way you have an extra day. Check out Buy Now, Pay Later before the prices go up on those amazing programs on building your wealth. Link down below. All right. Let's go listen in to CNBC.
Here's now. What does this rhyme? What does this rhyme like? Or what does this sound like to you? What does it feel like? Or is this one completely different and unique?
No, I think it is different. I mean, if you go back to 1994 when the Fed raised rates, fairly aggressively, that was only 250 basis points at the time. But issues in Orange County, issue with derivatives like Bank One and Shawmut, and the likes. Those stocks finished the year down 25%. Here the carry's been down, down 25% in a blink. So just the ferociousness that has come with us is a bit surprising. But you think back to the financial crisis, that happened much more slowly. But that in that instance, a lot of the concerns were kind of tied to losses on loans and assets that were truly needed to be marked down. Here, I think a lot of the concerns stem from unrealized losses on securities that most likely will mature at par. It's just they're long-dated, low-yielding assets, and the banks need time to work through them.
Jason, thank you.
Thank you.
We'll see if they mature at par. Coming up, the renewed rush into big tech. Longtime tech investor Ann Winblad will tell us what she's seeing in the sector, the future of AI, and Apple's bigger push into sports and entertainment. And a reminder, you can get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite.
Yeah, whatever. All right. No, I like CNBC. I like them. I think they're good people. It was really cool seeing them at the New York Stock Exchange. You might remember that I rang the bell at the New York Stock Exchange. That was really fun. I'm actually wearing my Nicey jacket right now. Well, I guess it's a vest. It's not a jacket. It's a vest. Who's seen those on TikTok, by the way? Oh my gosh, I gotta play one. Hold on. Let's find. Let's. Speaking of like TikTok and banning TikTok and stuff, let me play you a TikTok. I love this one. This one makes me so happy. Where is it? Hold on. It's I'll never be able to find it. Never mind. Really? It's like the finance dads. Finance. I'm gonna just search that. Let me see. Oh, here, I got it. That's funny. All right, you ready for this? Hopefully the audio works on this. Hold on, let's see. All right, here we go. I gotta play it because it's fun. All right. I don't know if the audio is gonna work though on this. Well, I guess we'll find out. I will just play. Here we go. It doesn't sound like some of you saying some of the audio may not have. So it sounds like maybe the audio didn't come through, but yeah, basically they're just like, oh, Dow Jones, oh, you gotta buy. Anyway, little tangents. Oh dear. Okay. All right. So, what do we want to cover now? There's so much. How about TikTok got you, bro? I've been had. No audio. All right. Well, good to know. Thank you for that. That's actually very interesting. It's not actually so terribly important. There was really no audio. It's just you just hear like sneakers and stuff. But anyway, okay. So this gives us a little bit. Okay, hold on a sec. What is this? Let's listen into Becky for a sec. What she says, she's got breaking news, but then there's also something else.
Summer. I don't know, but that is next on Squawk Box. We'll be right back.
What the hell? She literally came back just to say we'll be right back. That's so annoying. All right. Let me do a quick follow-up on Binance super quick. And we already talked about Yellen's flip-flop in the beginning of the video. All right, so quick follow-up on this. Apparently, Binance is also now taking the move to dump essentially $1 billion of BUSD. They're swapping it for BTC, ETH, and BNB. Some say this is because of $1 billion of buying pressure, which kind of or will create about $1 billion of buying pressure, which some say might have led to a little bit of a temporary bump in the prices of BTC and ETH. A lot of people have been seeing BTC pump, and they're like, why is this happening? Well, potentially it was Binance moving $1 billion of BUSD into BTC, ETH, and BNB. Now, why did he potentially pre-announce this? That is, why did CZ pre-announce this? Well, some people think that Binance pre-announcing this was potentially a post-announcement designed to pump up their own stake, so to speak, after they made their purchases. So think about this from sort of just a cynical point of view. You look at this tweet, you go, given the changes in stablecoins and banks, Binance will convert the remaining of the $1 billion industry recovery initiative funds from BUSD to native crypto, including BTC, BNB, and ETH. Some fund movements will occur on chain today. Transparency. Okay, right. Some fund movements will occur today. Okay, interesting. Either way, the point is, you literally have the potential for CZ to move markets with his own chatting on Twitter, which makes sense because they have a lot of capital. But what they've basically done is they've taken their cash backing and turned it into now a market float coin, which is pretty shocking. They're going to convert a stable coin, which is supposed to be 1-to-1 pegged to the dollar, so they say, and turning it into BTC, BNB, and ETH. It's the perfect sales pitch for the Binance token. It's the perfect sales pitch for ETH and BTC. It's the perfect amount of buying pressure to potentially get a rally moving. Whether they made the transaction right after the tweet or at the tweet, I mean, we could look at the chain history. It doesn't so much matter. What matters is it's essentially diluting the recovery fund and creating more risk while creating an ad for Binance. Kind of scary. Well, at the same time, some are saying maybe BUSD might come to an end since the issuing bank for BUSD is Paxos, and Paxos is now getting sued by the SEC, another SEC lawsuit. The supply of BUSD is now basically only able to go down. Redemptions are open, but you can't mint any more BUSD. Coinbase disabled trading for BUSD, so basically it's just like withdrawal only. You have this idea that potentially banks and institutions are trying to eliminate access to these stable coins at all, Binance being one of the targets for them. That's why Paxos is probably getting sued. Remember that Silvergate was the operator of the SEN network, the Silvergate Exchange Network, which ran 24/7, allowing those on and off ramps from crypto to dollars. But crypto is basically getting debanked right now, likely for political reasons. But this debanking is also creating a de-stable coinization. I totally just made that up, obviously. But anyway, it's interesting because the more you de-stable coin and the more you go to these free float currencies like Bitcoin and ETH, the more you actually potentially are vulnerable to a shock taking the whole system down. Now, it's unlikely that Bitcoin and Ethereum will actually go down entirely, but you could lead to substantially more rapid panic in the pricing of these coins and assets. So I don't know, not great in my opinion, not great. So anyway, that is a little bit of an append there of a thought on Binance. Let's now go back to CNBC commentary for a moment. Let's listen in to CNBC.
So much time on those revisions because the numbers weren't good on the surface. And when you take into account that last month was downgraded a bit, it really adds into the notion. I don't follow Fed dot plots, but we all know that this quarter isn't shaping up to be necessarily a good quarter. Many are seeing recession. I don't see a way to avoid it. Just to put a face on this, we all see what's going on with interest rates, 356 in a 2-year. Just think about this. On March 8th, it closed at 507. The high yield closed. That was the highest since 2007. Now we're at the lowest yields since September, 10-year. And we did the charts, a month ago? And about 5 months ago, I staked my claim here. 4.25 is the high. It was the high back in October. We never came back and challenged those fall levels. You remember, Joe, we did the Elliott wave count. It was clearly the high yield close. But man, look at how far we've fallen there. Is this really a banking crisis? Joe, you know what it is. It's a Fed crisis. It's a rate hiking crisis. It's a crisis built on a crisis we never solved. And now we have walkbacks, takebacks, Treasury secretaries changing their mind. Is it any wonder there's all this volatility in the markets? Back to you.
Good point.
People are testing. They're. I don't even know if they know anything about Deutsche Bank. Do they, Rick? They're going to test it. They're going to keep testing, right?
First of all, we test and we don't test for rates on some of the stress tests here. That's crazy. But listen, folks, we all need to take a step back. Okay, how many trillions of dollars of negative securities were hovering through Europe? How could anybody be shocked? I was shocked that the news wasn't worse 3 months ago, 2 months ago. Now we're starting to see the realities of it. And listen, I'm not picking on Jay Powell and the Fed. Their mission is almost impossible. When I do get a little stressed, though, is when they ask him questions about the government and spending and debt and fiscal dreaming and magic monetary theory. And he says, oh, no, I don't comment about that. He certainly seemed to have worked with them when the debt was being created. Now they leave us out to dry.
I forgot it was 507. We've been talking about that. So we're that's 150 basis point right there. Is that, did we go 100? Did we go 150 too far?
I don't know what too far is. Another thing we always forget is that the signals for the market were broken long before COVID hit. We had zero interest rate policy for so long. Who knew? We became, unable to notice all the aromas in the room. And I think that those aromas of debt and the fact that we had abnormal monetary policy really since the credit crisis, Joe, there's no way to tell if this is where we're supposed to be with rates or not supposed to be. Well, I think the most interesting trade to watch is that 3-month to 10, the way it's reinverted because bills have been a lot more solid than 2 years.
Yeah. Well, we saved the world twice, you could say, the Fed. And it'd be, if it was a 2-week crisis, that's all you had to do, or a 3-week crisis, that's all the comeuppance there was for all that extraordinary government help that we had. That doesn't make sense, probably. I don't know what it portends. I'm saying that it portends maybe inflation comes down. That doesn't have to be some disastrous economic scenario, but maybe our inflation problem comes under control. Let's see if Steve thinks that. Can we do it that way, Steve? Half full. Steve Leisman joins us now with more. I was saying if they have to cut by June, I'm afraid of what kind of world that is, but maybe it's a world where inflation is under control with a little bit of a slowdown in the economy. Would that work?
Yeah, I mean, you want to be a little careful how you get to where you're going, Joe, right? I mean, there's different ways to arrive.
I don't want to.
You can arrive. You can arrive first class, premium economy, or you can be hanging on to the wing, I guess, as you land. So I haven't done that before, but I've done some other things in some Russian planes before. But anyway,
here's a freeze in there.
No, not a wheel well, but I have been standing in the aisle of a plane and also took a couple Russian helicopter trips with loads in the helicopter that probably exceeded most regulatory limits. But in any event, I think, Joe, that you probably do get a downdraft to inflation and to the economy from what's happening right now with banks pulling back, probably in the lending department, and whether or not there's any offset in terms of lower rates or the idea that inflation comes down. It's not the way I would like to get there, to the lower inflation number. But I do want to look, Joe, at the Fed funds outlook right now, which is it's head shaking in terms of what's happened. It's unprecedented.
Look at those cuts.
Here we go. There's you can see that cut. This is what Rick was talking about. 455 now for July. So sometime by the summer, there's a quarter whacked out of it. Sometime by the fall, 80 basis points whacked out of it. And then you get to we use the January 24 for the proxy for the year end, and there's 120 basis points. And you can see that differential a little bit better when you look at the Fed market gap, which is also an unprecedented thing. We've just started tracking this in a thing that updates immediately. And what you see there is, I think it's 150 basis points. Yeah, there it is, spot on, 150. So what that's telling you, Joe, is that the Fed is 150 basis points more hawkish in its 2023 outlook than the market is priced right now. So there is some change that has to happen somewhere, someplace. Now, maybe all this concern about the banking system goes away and the market goes back to meet the Fed, or maybe the Fed says, you know what we just did was a mistake, and maybe we have to backtrack to give the market something more. You asked a great question, Joe. What is what do the regulators do this weekend? I mean, I think they would love to come out Monday morning and say, here's a blanket coverage for all uninsured depositors. I just don't think, as I've said all week, they don't have the authority to do that. They need Congress to do that. So all they can do is say it's a case-by-case basis. Yes, I think they have the money. I don't think they're constricted by the money, Joe. But
yeah, we could print it and it'd be worth 10 cents of what it's worth right now.
I
know. Yeah, right. It's unbelievable, though, Steve. How I always say things happen gradually and then they happen all at once. There was no gradual here.
All of a sudden, yeah.
Really?
No, I think that's the way. Yeah, I mean, I think that's the way these things happen, right? Is that you didn't really have an issue with banks. And in fact, people were remarking, and I was probably one of them that said, hey, all this QT is taking place and rate hikes are taking place, and the banking system looks like it's in pretty good shape. But you know the market, Joe, it finds the weakness, and it found it in Silicon Valley Bank. And then it started raising questions about other aspects of the banking system, like how secure is the deposit base of the smaller and regional banks?
Right.
And
now what's going on in
what
Europe,
does it mean to have?
Now you got to figure out what.
And now what's going on in Europe?
Tell me what happened at Deutsche Bank. I didn't think it was Credit Suisse.
Well, I think this could have been an unforced error, Joe. I don't know, but the way that the way the regulators treated those AT1 bonds, I think. By the way, guys in the back, we do have the credit default swap for Deutsche Bank, I believe, in the system now. Our great Gina Francola sent that around. I don't know if you can get that, but that is higher. It's in the 170 range. It's about half of what it was during the. There we go. They're so good in the back, aren't they, Joe? But look at where you are there. I don't know how much further you can take that out, but that's supposed like 300 plus back in the financial crisis. So it's not that level, but you can see it's quite a bit higher. And this, according to the analysis that I'm reading, reflects the concern about those bonds, those that were supposed to be bonds, and now they're treated worse than equity.
All right, I'm going to pull off this. We've covered this already earlier. If you haven't seen it, scroll to the beginning of the video. That's when we started with Deutsche Bank, and we covered the CDSs and what's going on with the banking crisis. So that's at the beginning of the video. But you know, what's really worth talking about here is Rick's freak out at CNBC. So let's talk about Rick's freak out. Hold on, let me actually do this really quick. All right, here we go. Okay. Let's talk about Rick's freak out on CNBC and what it could mean for the future, specifically what it could mean for rates in the future. So Rick makes this argument that, look, we were basically drunk off cheap money for too long. After the global financial crisis, we had zero interest rates. That is, the lower bound of the Federal Reserve was zero. So money was cheap and easy. Even though we were coming out of the great financial crisis where dead people were getting loans for homes and lending standards tightened substantially coming out of the great financial crisis, basically what you said is poor people can no longer get loans, but rich people can get really cheap loans. That's basically what you did coming out of the financial crisis, because you led to substantially more stringent requirements for lending, which ended up increasing the requirements to be able to get home loans, bank loans, business loans, lines of credit, credit cards, car loans, you name it. And that enabled a 10-year run of people with access to cheap capital becoming wildly wealthy, whether that was through investing in stocks or investing in real estate, which is a substantially easier way to do it, in my opinion. For example, had I put my first $18,000 with Lauren into the S&P 500, we would have turned it into $64,000 by around COVID. So let's just say the end of 2019. So S&P 500 for about 11 years would have turned into about $64,000 by the beginning of COVID, end of 2019, we'll call it. Instead, we put that money into real estate, leveraged that real estate with cheap money, and took advantage of the beautiful type of financing that we were able to get after the great financial crisis. And what happened? We turned that $64,000 into over $275,000, or that $18,000 into over $275,000. So substantially more than what we could have gotten, certainly without risk exposure, right? There's no risk exposure in real estate when you can rent out a property for more than what your payment was then, because rates were so freaking low and prices were so low then. You had no risk, basically. Whereas in stocks, you go in margin, you have massive risk. All it takes is a quick flash crash and you're out. So Rick's argument here is that we were drunk on cheap money for the last decade, and that now the Federal Reserve is basically saying, look, when you guys need to print money, we'll print as much money as you need. When Congress wanted as much money as possible to print for COVID, we'll print it for you. In fact, it's actually really funny to think about. I did this, and in hindsight, it's like so weird. But I did this, and then I want to talk specifically about going forward, what we think might happen with rates again long term. I really think it's worth discussing a little bit. But before we do that, I want to show you this idea, because it's spawned by what Rick Santelli just said. He said, look, Jerome Powell gave no pushback to this idea that, hey, look, maybe we shouldn't be printing all this money. No pushback from J-Pow. When it was time to print money, no pushback. When it was time to tighten, now you don't want to be real with us about how much you really have to tighten and how much you're basically walking the economy into a recession, right? So what I'd like to do is quickly share this particular tab here. Let's share this and take a listen to this. You should be able to hear this. So let me know if there's a problem with the audio. But look at this. You could look at this free money, Jerome Powell's Halloween. And what we did is we basically did a Halloween as I dressed up as Jerome Powell and my father-in-law dressed up as Janet Yellen. And we literally gave money away along with candy. We gave $2 bills away to people along with candy. And then, of course, we made it rain money as well because, well, the money printer was on, right? Is my son Jack. But anyway, what was funny, and I'm just thinking about it in hindsight now, is let me go to the transcript so we can get it quickly here. Print, because I print money. Where is it? The money we've printed. Print. Ah, yes. Okay, here we go. Listen to just this segment really quick. Come on. All right, come on.
So far, we've given away about 80% of the money that we've printed. Janet, we might have to go back to the printer and print more.
If so, we will do so.
Excellent. Do you think we'll get the authorization from Congress?
Of course.
Nancy Pelosi will let us print more?
Of course.
Joe Biden will let us print more?
Yes.
We'll be able to print more.
Like, looking back to this, it's just like, of course. Like, of course. The writing was on the wall. Like, they'll just print more. You need more money, we'll just print more. And that's really Rick Santelli's frustration here, is that there was no constraint on how much we were able to print. And now we are having to pay for that. And the question is it really possible, as the other CNBC anchors mentioned, that we could just go through a little short period of pain, and then all of the money printing that we did and the pain we had to go through basically pays for that inflation in a very short period of time? Maybe. And that's the question. See, if you're wondering about recession, you have to ask yourself this. We were talking about this yesterday, the team and I. I asked, look, if a normal recession is a decline in GDP of 0.5% to maybe -2%, if that's a normal recession, right? Let me ask you this. How bad would a recession be if GDP contracted 10%? Really bad, right? That's the assumption. But wait a minute. You have to ask the question correctly. How long? Let me ask you this. Could you get through a 10% contraction in GDP, a massive recession, for a month? Probably. You'll just spend through it. Okay. Could you get through it for 3 months? Probably. Just spend through it. Could you get through it for a year? Probably not. 10% contraction would be devastating. The amount of job loss would be insane. Now, where are we today? Well, we're not going to face a 10% GDP contraction. But the question is, how long does the recession last? Because it's almost a foregone conclusion now that the recession is going to happen. Jerome Powell's recession indicator is flashing massively red. And it's basically screaming at us saying, we are going into a deep, dark recession. And that indicator is actually right here on screen now. Powell's curve says recession is confirmed. Gap between current and future short-term rates signals steep cuts coming in interest rates and a massive inversion here of the yield curve. This yield curve inversion we have not seen since the dot-com recession. Now, this inversion is the difference between the 3-month Treasury yield, which is around 4.5-ish right now, and the 10-year Treasury yield, which is around 3.3. That means people are demanding a higher yield on their money today than they are for the next 10 years. That's because we think inflation is going to remain hot for the next, certainly at least 3 months, but potentially even more. So people are demanding more of a premium, and that's why you have this inversion of the yield curve. Now, the only way you could explain away, there are 2 ways you can explain away the inversion of the yield curve. One, you could say, well, that's reasonable. If inflation goes down, of course, people are going to expect a higher rate today because they have to get through this period of inflation. So they'll expect a higher rate now and then a lower rate in the future. That's why the yield curve is inverted, because there's high inflation. We didn't have high inflation in 2000. The problem with that thesis is pretty much every time the 310 has inverted in the past, it's led to a recession within the next 18 months. And so now the question becomes, how long is that recession going to be? And how much pain are we going to suffer? Well, let me tell you my base case, and then let's go to the worst case scenario. So base case scenario is that we have a massive amount of disinflation that comes from housing services this summer. That combines with goods disinflation and the start of services ex-housing disinflation. That's like labor, hotels, hospitality, whatever. And come July, August, September, we start having potentially even negative prints of inflation. And month-over-month prints, those would be year-over-year likely negative, but month-over-month prints hopefully close to 0, 0.1, 0.2% acceptable. As long as we have that sort of disinflation this summer, again, 0.1, 0.2% on the month-over-month acceptable, then the recession will probably come. We will probably go into recession. But the recession might be short-lived. And short-lived is very important. So inflation goes away come June, July. We cut rates like crazy, as we saw from CNBC. The rate cut curve, as you can see on screen here, the rate cut curve is substantial. We expect to be 1% lower on rates by the end of the year. So massive rate cuts being priced in starting this summer. And what happens? Well, you end up having a shallow, maybe 2-quarter recession. You cut rates substantially, you turn the money printer back on, and everything goes back to normal. In the meantime, people who lose their jobs or have revenues decline, what do? You spend through the recession. And the stocks that will do the best in a spend-through type of recession, in my opinion, are going to be people or who spend money on expensive items and high-quality brands that have pricing power in a shallow recession. That's my base case, and I'm putting my money where my mouth is. Now, every time I flip-flop, I send alerts and I talk to specifically first course members about all of that, which now it's worth noting, if you want to join the courses, you can actually sign up using Buy Now, Pay Later. You can sign up for the courses, sign up for as low as $48 a month here with a firm, and you can buy now, pay later for the courses on Building Your Wealth Now. Check those out, linked down below. We've extended that coupon code that expired Wednesday, was supposed to expire Wednesday, just for today. So you could use that buy now, pay later service if you're so inclined to do so. But you'll get lifetime access the same. Even if you use a buy now, pay later service, you'll get lifetime access to the programs on Building Your Wealth, which is pretty cool. So check those out. Linked down below. Most popular bundle right now is the 0 to Millionaire Real Estate Investing and the Stocks and Psychology of Money. Though more and more now are starting to triple bundle with the Elite Hustlers because they want those weekend live streams as well. So check that out via the link down below, and you can now buy now, pay later for those programs on Building Your Wealth, which is pretty cool. So again, check that out. There's Klarna, there's Affirm. There are plenty of different options that you can now use. Linked down below. But anyway, that's the base case scenario. What's the worst case scenario? Which I diligently research myself with my team on a daily basis to find, okay, how exposed are we to a potential worst case scenario? Well, the worst case scenario is problematic. The worst case scenario, unfortunately, is a situation where we have a longer recession. That is, inflation stays sticky. If inflation stays sticky, you probably don't want to be invested in the stock market because even pricing power stocks will suffer then. If the recession ends up lasting throughout not only the second half of this year, but all throughout 2024, pricing power stocks will suffer. You will not want to be in margin going into 2024. The start of the recession might not actually mark the bottom of the stock market because the earnings pain that comes could be very bad. So in the scenario of sticky inflation, we would actually not have rate cuts. We would, because remember what the bond market is pricing in right now. The bond market is telling you rate cuts are coming. The Federal Reserve is saying rate cuts are not coming. So why is there such a difference between what the Fed thinks and what the market thinks? Well, it's for two reasons. Number one, the bond market is looking at leading indicators of inflation and is suggesting that rates are going to get cut. The Fed is playing a two-folded game. One, they're playing the game for the worst case scenario. The worst case scenario, we have to keep rates high for longer or even raise them more, which means longer, deeper recession. But also, if they admit that we have to cut this year, then they might actually undo the progress they're making on tightening. Because if the Fed comes out and says, yeah, we'll probably cut by 1% by the end of the year, they're admitting to a recession. They're admitting to turning the money printer back on, and people will go spend willy-nilly again. Stocks will go to the moon. That's what they don't want to happen. They don't want financial conditions to ease, so they have to put the hard face on for the worst case scenario. They basically have to lie to us for the worst case scenario to minimize the worst case scenario and to make sure the best case scenario actually occurs. And then, of course, I mean, the best case scenario is that inflation's gone tomorrow, but then everything goes back to normal. Then you might not even have a recession. Base case scenario is shallow recession. Worst case scenario is deep, long recession. So that's really what the market's dealing with right now. Now, where do we think rates could go in the long term? Well, personally, I think in the long term, there's actually a possibility, actually a high likelihood, that we're probably going to go back to zero, the zero lower bound, within the next 4 years. I think by 2027, we'll probably be back at 0% interest. By the end of the decade, we'll certainly be back at 0% interest. And before 2040, we'll probably be looking at, 2040, 17, I'll be older. Anyway, by 2040, we will probably be at negative interest rates. That's my thesis. And not deeply negative, but we will probably be at negative 0.25%, negative 0.5% in interest rates. Yeah, you will get punished for saving. You think you're making 4% now on treasuries is going to last? That ain't going to last. It's going to go negative again. And that's going to be because of the acceleration of deflation, thanks to autonomy and AI. Now, there was actually a funny quote in the stock on Twitter yesterday. It was a Goldman Sachs quote that somebody posted on Twitter. And the argument was, the bond market is pricing in a recession. The equity market is pricing in artificial intelligence. Part of that is because of NVIDIA's skyrocketing, which I believe is actually pricing power stock. I bought a lot of NVIDIA in the mid 100s, exposed myself to a lot of that, but it's getting a little frothy over here. 270s. It's a little expensive out of some of the other options that there are. Still not as expensive as a TSM and Apple though, but it's getting starting to get up there. But anyway, is it possible that we were just drunk on cheap money the last 10 years? Yes, that's possible. Or the great moderation is real. And this 40-year downtrend of inflation and this 1,000-year-long downtrend of mature economies seeing declining rates, neutral rates of interest, which means declining interest rates. Is it possible that will return and that all this COVID transitory inflation of money printing will just end up being transitory? Yeah, that is possible. That's very possible. Now, transitory will end up probably having been 21, 2, 3, 4, be like a 3 or 4 years of transitory. But, when we zoom out on sort of the macro, it'll end up being a sort of a blip, transitory blip, potentially, if the base case holds true. If we go back to the Peter Schiffian style long-term inflation, then eventually the dollar will collapse, which I do think that at some point the dollar will collapse. I think that point is still hundreds of years away. Peter Schiff thinks it's, months away, or potentially a few years away. So I think then it just depends on your thesis. But my take is base case, inflation goes down. You want to be invested because of a potential Nike swoosh style recovery where, yes, we have a lot of volatility, fears of these banking crises, Deutsche Bank, Credit Suisse, who's next? What else? What's the next shoe to fall and drop? All while Jerome Powell's still hiking and credit conditions are tightening, which will lead to a deeper recession. I think that Nike swoosh recovery holds in the base case. If inflation stays sticky for too long and we don't get that disinflation we're expecting in the summer, we're screwed. And the base case goes to hell. So anyway, so there you have it of my thesis and response to Rick Santoli. All right, let's get to the next one. So, okay. Japan-style stagflation. I don't think so. They lost their creative edge. I like the video showing your father-in-law process of dressing up as yellow. Yeah. The money printer vid was fun. That was a fun Halloween. That was really fun. All right. Now we're going to react to the co-founder of Home Depot. This should be a fun piece. All right. Let's see here. How am I going to do this? Present. Share screen. Huh? Oh, am I doing it? Oh, I'm doing it. All right. Here we go. There we go. All right, we're looking good. All right. Now we have to react to the co-founder of Home Depot slamming and calling out Joe Biden and the Federal Reserve. Let's go ahead and play this because it's pretty in-depth. Before I do, quick reminder that you can now use Buy Now, Pay Later to check out on the programs of Building Your Wealth, link down below. Briefly extended that coupon so you could use Buy Now, Pay Later services to build your wealth. Check out especially that Zero to Millionaire Real Estate Investing course and Stocks and Psychology of Money. All right, let's now get into this piece. Here we go.
Democrat Senator Elizabeth Warren went at it yesterday, clashing on Capitol Hill. Warren is slamming the Fed's inflation strategy, claiming that it will get people fired. Watch.
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. And we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it.
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Jeremy, right?
Yeah, it's worth noting before we get to the response of the Home Depot co-founder that is actually exactly what Jerome Powell's argument is. That yes, there will be pain going through this tightening process, and you should prepare for it. But some job loss is better than a lot of job loss. That's basically the argument Jerome Powell is making. No Elizabeth Warren, they didn't show it all here. She made a fantastic historical comparison, suggesting that when the unemployment rate rises 1%, it generally goes on to raise another 1%. So in other words, we're at about 3.4, 3.5% unemployment right now. The Fed is projecting that's going to rise to 4.5%, which actually means they're telegraphing it's probably going to go up 2% to 5.5%, which means potentially as many as 3 million job losses. Yikes. Let's listen to the response, though, from the co-founder of Home Depot, because he has some choice things to say. Let's go.
Right now, to look at the economy, the macro story, is the co-founder of Home Depot, Ken Langone, is here. Ken, it's great to see you. Welcome back to the show.
Hi, Maria, how are you? Thanks for having me.
I'm doing well, and I hope you are too. I want to get your take on the current business environment under the Biden administration. Ken, you've got investments in a whole host of industries and have a great vantage point to tell us what you're seeing on the macro story. How do you assess?
Well, first of all, Maria, I would classify the Fed as a gang that can't shoot straight. This goes back more than 18 months.
Yikes.
When they were saying that inflation was transitory, and smarter people than them, namely Stan Druckenmiller and people like Stan, were all saying the exact opposite. So they got started late on the fight against inflation, and now, frankly, they act like the gang that can't shoot straight, because we should keep raising rates until we break it. Now, it's going to be some pain. Senator Warren, she talks out of both sides of her mouth. What she doesn't realize is the people who pay the most for inflation are the lower income people. Inflation is the most regressive of all taxes ever. We don't like paying higher prices, but we can afford to pay higher prices. Nothing changes in our life. But a family of four living from paycheck to paycheck has to start asking the questions, do I go with meat or do I go with a substitute? And on and on and on, because these people are really being impacted. There's no simple way to snap the back of inflation. The Fed needs to be more aggressive and needs to be determined to make it happen.
Wow.
My problem with the Fed overall is there's too many academics in the mix. I think if you had more business people involved or people with business backgrounds, I think you might see a different dialogue and different decisions.
Yeah, that's a
For
great
sure.
point. Yeah.
For sure, Maria.
Yeah.
We would have raised rates a lot sooner, a lot higher to get a control of inflation. It's now out of control.
Yeah.
And I think, frankly, I don't know how you avert a serious financial crisis where we are right now.
Yeah.
I don't have any idea how you do it.
Well,
and now it's a more distinct possibility.
Well, there's also this issue around wages and this tight employment market, right? I mean, what are you seeing in terms of jobs? Because Jay Powell yesterday called the labor market, quote, extremely tight. Ken, this morning we get news that President Biden is proposing a 5.2% raise for federal employees in his budget. So the budget's going to be out tomorrow. And, you know, going into it, they're leaking the story that he's going to propose a raise for federal employees, the largest salary boost, Ken, in 43 years. So if you're raising wages right now, what does that do for the tight market that we're already suffering under? I mean, don't get me wrong. It's good that employees have seen their wages go up. But it's a problem for businesses. Look at Home Depot just recently saying they have to spend $1 billion because of this tight labor market.
Yeah, and keep in mind the people getting wage increases right now. And by the way, let me know if this audio is any better or worse. The people getting wage increases right now are generally the people working under about $20 an hour, which actually lowers your average wage, since the average wage in America is about $32. But yeah, wages have gone up across the board. I mean, just yesterday, the Wall Street Journal was reporting on how much wages have gone up at construction jobs. Wages rising substantially at construction jobs across the industry. Massive demand for construction. Specifically, you're seeing individual workers seeing massive wage increases from, in some cases, specialized contractors seeing their wages go from $35 an hour to potentially as high as $45 or $50 an hour. So massive wage increases. Now, fortunately, there's been a massive increase in available labor supply that's helped. That's been evidenced by what we've seen at companies like Uber, Lyft, McDonald's, Chipotle. But the construction industry, for example, is looking to hire an additional 500,000 workers just to get back to normal pace in 2023. So there's still massive demand for workers. And so you are still seeing some inflationary pressures. And that is going to keep some of these services inflation somewhat sticky. Now, the Home Depot co-founder here is suggesting, hey, we need to increase how much we tighten the noose basically on the market to contain this inflation, because average working people can't afford this stuff anymore. Hourly wages for general construction workers are up 42% from 2019 to today. That's incredible. Absolutely incredible. All right, let's keep going here.
Well, we want to make sure our people are taken care of. Maria, to me, the first obligation you have in business is taking care of your people and make sure they're treated fairly and make sure they're living in a way that they're comfortable. We made that decision. I wish I was there to be part of it, but I'm retired. But thank God the company under Ted Decker's leadership made the decision. We have to do something for our people. So we by the way, we did it all at once.
Yeah.
We did it at the end of January. It's $1 billion. It's a lot of money, but our people need it. And with Biden, let me say this to you about Joe Biden, in my opinion, and I'm going to be very, very direct. He thinks he's the smartest guy in the room. If that's the case, we're really in trouble because the American people are a lot smarter than that, and they see it.
Yeah.
And I'm afraid, Maria, the American people need to understand there's no pain, no gain. Maybe we're going to put 2 million people out of work, but I don't know any way around dealing with the problem of inflation and the tragedy of what comes with inflation. As I say, the poor people, the little people, the people living from paycheck to paycheck, they're the ones that get hurt the most.
Yeah. Which
And
is
we got
why,
to think about them.
which is why umpteen times you've said in the past, I don't need Social Security. I don't need these checks. Do something about it. Try to make sure Social Security is solvent. It's about to go insolvent in 10 years, and yet there's no plan to fix it. We're waiting on the president's budget tomorrow, and we're also waiting for this debt showdown to take place, right? The debt ceiling has to go up at this point. We have to pay our bills, but will they come up with any boundaries to spending, Ken?
No, what they'll do is they're already talking about raising rates. Look, Maria, I've said since the day I got a Social Security check, this is outrageous. I did so well in this system. I did so well under capitalism. It would be a travesty for Elaine and me to take any money from the government, any at all. And very frankly, what we do is we give those checks to charity every month.
Nice.
Why? Because if you try to give it back to the government, forget it. And if you gave it back to them, they'd only burn it more.
Yeah.
But I think politicians, this is why we need term limits, Maria, because until we have term limits and people understand they're going home, people are not going to touch the so-called third rail of politics, which is entitlements.
I'm really glad.
I got a 10%. My Social Security check last month, mine alone, not Elaine's, was $3,500. This is crazy.
Yeah.
That was 3/4 of what my starting pay was when I went to work 65 years ago.
But look what you and Elaine are doing. You're giving it all away. You're giving it to NYU Langone Medical Center. You're giving it to the arts. You're giving it to cancer research. You're giving it to you know, animal hospitals. You're giving your money away. You don't see that all the time, but you're doing it. And I'm glad you brought up term limits, Ken. We've spoken about this in the past. How is it possible that a politician goes to Washington and ends up spending 40, 50 years? They forget who they're working for. And I want you to know that I spoke with West Virginia Senator Joe Manchin on the phone the other day. He came on the show, and before he came on, I talked to him on the phone, and he said to me, you know what, Maria?
A very good friend of mine, Maria.
And he said to me, people are not going to like what I'm going to say, but you know what? I'm for term limits. And I said, wow, Ken Langone told me the same thing. He wants term limits. You even have a sitting Senator, Joe Manchin, calling for term limits. But the people who are going to decide this are the very people who are going to get impacted. So I don't see it happening, Ken. What about you?
Well, I don't see it happening, Maria, unless the American people get so fed up. I mean, we need by the way, Maria, with all due respect, thank you for your kind words about what Elaine and I are doing with our good fortune. But I'd be less than honest if I didn't say we're also keeping enough to live well, thank God. But really, we need term limits. I had an argument pushed at me last week. Two elected officials in Washington together said, well, you know, if you go to term limits, the staffs are going to run the government. I said, what the hell are you guys talking about? The staffs run the government now.
Right.
These guys haven't got the slightest idea what the hell they're doing.
Yeah.
And Maria, I'm serious. If and when the big crash comes, it is not going to be pretty.
Ugh.
It's not going to be pretty. And if we worry about China, we have to worry about China vis-a-vis a weakened American economy, a very weakened American economy.
That's right.
That's where you really run the risk.
So, Ken, real quick, we just talked to Larry McDonald. He said there's going to be a stock market crash within 60 days. He's talked to his institutional contacts to come up with that. But I want to get your take on market performance and what's priced in here. You're a big investor. If you expect we're going to see a recession, if you expect things are going to slow down quite a bit this year, does the stock market fall off, or is it priced in?
Maria, let me say this. I'm impervious to that argument for one reason. I'm a very long-term investor. My average holding, that's the weighted average of all my positions, is 41 years.
Wow.
I've owned my Lilly now, it'll be 45 years this November. Home Depot, of course, we founded it in 79. Yum Brands, 25 years. Parker Hannifin, one of the newer additions, 13, 14 years.
Okay.
Bad times come and bad times go. My advice to people is own great companies, great managements, strong balance sheets, a history of periodically raising dividends, and go fishing.
Yeah. I like the go fishing part.
And put money with Stan Drucken. By the way, put money with Stan Druckenmiller if you can. He's never had a losing year.
Wow.
And I've had the good fortune to be an investor of his since he had less than $1 million in assets.
That's pretty impressive.
But Maria, I'm not smart enough. These pundits that are saying we're going to have a crash in 60 and 9, they may be right, but they also may be wrong.
All right.
I'll bet against America.
Yeah.
My pitch on investing, Maria.
Yeah.
Bet on America. We're the greatest country on earth. We always will be. We're going through a rough patch. We will get it right. Not without a lot of pain, but we'll get it right.
Amen
That's my
to that.
pitch, Maria.
Ken, it's great to see you. Thanks so much.
God bless you.
And
Say
to
hi
you.
to Jono, please, and have a great day.
I will. Thank
Bye-bye.
you, Ken.
All right, so let's add some commentary on that. Wow. Well, first of all, super admirable. The guy's donating his social security check. That's awesome. It's also really cool. I mean, I'm sure he donates more than that. He's got plenty of wealth. You know, there's really no need not to donate more than that at that point. But good for him. That's not to try to minimize what he's doing. But he makes two really good arguments. That number one, he amplifies how important it is to handle inflation, because if we don't handle inflation, then as he said, the little person gets screwed, especially the people living paycheck to paycheck. And that's why, as an investor, I hate to say it, but I'm purposefully trying to avoid investing where regular people are buying things right now. The Nike, the McDonald's, the Costco, the Staples, the Target, the Walmart, the restaurants. I'm trying to stay away from all of that. Let me put it this way. When you go to Cheesecake Factory or Red Robin Gourmet Burgers right now, you're eating at a charity because they lose money. They lose money. You sit down and eat, you make them lose more money. That's how bad costs have gotten at restaurants. If I really want to be exposed to staples, even like Home Depot or Lowe's that are raising all of their employee wages, which is fantastic for them, but their costs have exploded so much, I don't think they can make any money here in the near term. Now, I love his argument about invest for the long term, invest in companies with great balance sheets, but my answer to that right now is pricing power stocks that appeal to the higher income business or consumer. Think about business. Businesses need servers. They need data centers. They need artificial intelligence. Invest, in my opinion, in those sorts of options. Look, I'm a licensed financial advisor. I can't give you personalized financial advice. I run an active ETF. You can learn more about it at meetkevin.com. I've got courses on building your wealth. You can now use buy now, later platforms to pay for it. I don't recommend you do, but if you want to, you can. People have been asking for it. And yeah, we extended the coupon code to today because you can check out using that buy now later platform if you want. But the point is, I think you want pricing power stocks. And what you want to look for in the balance sheet is you want to look for companies with massive free cash flow. That is the opposite of what you're seeing at companies like a Coinbase right now or a Roku. These are cash burning businesses. Let me give you an example just by showing you Roku. And we do stuff like this in the course member live streams on almost a daily basis where we go through cash flow statements, balance sheets, you name it. Let me show you Roku, okay? So here's Roku. This is the balance sheet for Roku. What do we see on the balance sheet for Roku? Well, right now we see that they have negative free cash flow of 172. Actually, I did that math slightly wrong. It was actually 11. They have a negative cash flow of about $150 million. That's because they have a slight positive on operating activities, but they're only able to get this slight positive of almost $12 million here thanks to their purchases of plant, property, and equipment. So you've got a negative cash flowing business over here. And unfortunately, you've got a business that does have a net run of about, they've got about $1.1 billion in free cash available after their current liabilities. But when you consider that they're burning about 150 mil here, per quarter, and they're barely making money on the business, you go, okay, well, at some point they might have to raise money. Now, Roku a little bit more insulated than other businesses. For example, if we divide that, they've got about a 6-year run rate. That's not bad. Maybe Roku could end up going profitable. But then you have to ask yourself, do they actually have pricing power on their business? Well, they have a business that went from profitable in 2021 to income losing in 2022. They went from making $21 million to losing $250 million. That's because their SG&A, their sales, general, and administrative expenses basically doubled. Their R&D nearly doubled. At the same time, their revenue barely went up. You went from about $700 million in 2021 up about 4% to $731 million. Their devices revenue actually shrunk. Now, their devices are loss leaders anyway because they want more subscription revenue. But the point is, on top of that, they're also seeing their costs explode. Their costs exploded 500 basis points. So their revenue is growing 4%. Their operating costs are doubling. Their margins are shrinking. And yeah, they've got a 6-year run rate because they made a lot of money during the boom market selling their stock. And that's fantastic. But is it actually a profitable business model? I don't know. It's not something I want to be exposed to. Now, look, when the Fed's money printers turn back on, everything's going to go back to the moon. So maybe it doesn't matter. Maybe it's unfair to bag on one company. But personally, I want to be looking at companies that have massive free cash flow. Very, very, very massive amount of free cash flow. That's what I care about. Big free cash flow. Big PP is what I call it. Pricing power stocks. So, look, that's just my opinion, right? Now, again, I want to be very clear. If you think that big recession is coming, like we just heard Ken, the co-founder of Home Depot, talk about, then you just don't want to be in stocks. But if you want to invest like Ken, then you look for high-quality companies that you think could be here for 40 years. Like he mentioned, his average hold is 40 years. That's admirable. Now, there are possibilities you could walk into value traps. For example, I think one that potentially is a value play right now is Intel. But Intel could be bankrupt in 5 years if their investment into new fabs fails. They're exposing themselves to both the RISC architecture ARM and x86, which is fantastic. They're being very smart. They're basically becoming chip agnostic. We don't care what chip you want. We'll just make it for you, which is fantastic. Very, very smart. And with all the subsidies from the government for CHIPS Act, I can't see that going wrong. But that might be more risky than potentially investing. Well, I should say, just like Taiwan Semiconductors could be risky in the event there is some drama between China and Taiwan that extends. I think that's highly unlikely. I think it's very unlikely that China ends up invading Taiwan. I think that's their worst case scenario. But what American companies are probably here to stay, at least for now, for the long term. Probably your Teslas, your Apple, your Enphase, your Nvidia, your AMD. These are fantastic American companies that appeal to a higher net worth business or individual. And that, I think, is where you want to be positioned. That's just my take. And so I'm a big fan of pricing power style stocks like that. Learn more about, my courses and some of the other services that we do, like even the ETF, by going to meetkevin.com. Cool. Let's now jump on over to see what CNBC has to say. So let's share. And we'll go here. Let's turn them on for a few minutes. Let's see what they got.
To the court date with the FTC, which won't take place until I think it's August. So, Jim, that's a key one.
Yes,
that's a key one.
I'm glad you brought that up.
Yeah.
I do think that we need to get away from ideology, and they got away from ideology.
Yeah.
But by the way, Lena Khan will be very hard pressed.
Yes,
because she believes it's not ideology; she thinks it's doctrine.
And
doctrines is a questionable thing.
They, in front of this judge, they're going to have a very hard time.
Yeah,
with
trial
some would
switch
say
is
proving
not
their case.
Wow.
Yeah.
They're going to go to commercial.
Vision shares up nicely there again. Okay.
Lame.
No longer mostly dead. Coming up, it is Kramer's Mad Dash. We'll count you down to an opening bell 8 minutes from now. We are set up for a lower open on this Friday.
Yeah, we are.
See right there.
All right. So let me see if there's something else we can share here. I wonder, what's actually going to be very curious to me, especially since my iPad's been having some issues on the mobile here. I wonder if I can share my screen just on my computer. That would be cool for my notes. Because I wanted to show you. I might have to do that later, but let me test it really quick. Window, does it work? What does this look like? I guess that works. I mean, I'd prefer this to be in some kind of presenter style where it, it doesn't show all this junk. I'll have to play with that. Sorry to do that with you live. I guess I could hide that. Yeah, but it's better than nothing. It's better than the flickering you get on the iPad. So I suppose it works. If I go to, I don't know if that's a good idea. Do we have a pointer? Yeah, we do. Oh, my little light just died. Oh, well. Okay. Well, anyway, basically, here's a Wall Street Journal article. I'll give you this sort of as a little bonus here. So I went through this Wall Street Journal article. It wasn't as great as I thought, but there were some fantastic arguments within it. Renovations now take 79 days on average longer than they did in 2019. They take an average of 79 days, up 259% from 2019. A lot of people are frustrated about how things are going over budget, how hard it is to find workers. People are becoming do-it-yourselfers out of necessity. Yeah, it was interesting. I mean, I like reading a lot, so sometimes I read stuff that isn't great. It's not worth, its own little video, but I thought I'd make a mention on it. So anyway, yeah, some thoughts here. I got to go now. I got to go to the course member live stream and get another cup of coffee from right behind me, and then I'll go to the course member live stream. So I'll see you in the next one. Thank you all so much for being here. It was a blast. A little tougher with the mobile studio, but I think we still did our best. Appreciate y'all for being here. We'll see you soon. Bye, everyone.